2023 has undoubtedly been the most peculiar year in terms of my investments, and I've been in this game for a long time. Now, I can't help but sympathize with the new investors entering the stock market because it's a challenging terrain to navigate if you lack knowledge. That's precisely why I'm creating this video, to provide a framework that will assist you in maneuvering through these rather intriguing times and avoiding any potential losses. Please note that this video won't turn you into an investment prodigy instantly. However, it will set you on the right path to making wise investment decisions during volatile periods. In this video, I'll be sharing 5 tips that both Warren Buffett and other successful investors rely on to outperform their peers and achieve long-term success. So let's dive right in. Number 1, emotions. One of the factors that will distinguish average investors from quality investors in these times is their ability to manage their emotions. Let's use an analogy from Jordan Peterson to emphasize this point. He advises us to be reliable individuals, even at a relative's funeral. Extending this advice to the world of investing, particularly during and after a market crash, becomes crucial. The mindset adopted by the majority of investors is to experience extreme emotions based on the fluctuations of the stock market. When their stocks rise, they feel immense happiness and rush to share their gains with friends at the bar. They frequently check their stocks, sometimes even on a daily basis. Their emotions are entangled in the ups and downs of the market. On the other hand, a small percentage of successful investors choose to go against the grain. These winners exhibit a different approach. Instead of being euphoric when their stocks rise, they welcome price declines as an opportunity. A decrease in stock price means they can purchase more shares at a lower cost. They understand that the cheaper they buy, the higher their returns will potentially be over the long term. This concept is precisely why Warren Buffett remarks that the marketplace is filled with individuals who do not take investing seriously. It resembles a vast casino where everyone else is enjoying themselves and indulging in excessive drinking. To truly succeed, investors should aim to buy low and sell high. Unfortunately, the majority of investors end up doing the opposite. Number 2, understand your investments. To gain an edge over other investors and achieve high-level returns, it's crucial to invest in areas where you have expertise. My recommendation is to take a step back and evaluate the domains you are familiar with. If you're a young individual, it could be gaming, artificial intelligence, social media, or any technology-related business. For those who are older, your advantage might lie in more mature industries like hospitality, travel, wine, or food. Look at Warren Buffett. He focuses solely on business models he knows well, which have been around for ages, and the insurance sector, where he dedicated considerable time to understanding the intricacies, is one such example. Buffett's deep knowledge enables him to identify good investment opportunities, and you should follow his lead. If you're young and have an interest in gaming, chances are you have a better grasp than most on which companies will thrive in the future and which industries will take off. That's why Peter Lynch's famous quote is so simple, yet genius. Know what you own and know why you own it. Unlike most investors who aim to make money in every industry and boast about their diverse portfolio, it's crucial to stick to the industries you understand well. Don't just own something without understanding it fully. That's why you shouldn't fall into the trap of being like most investors. Number 3, understanding the basics. Imagine if I approached a complete novice to poker and invited them to join my friends and me for a game. We each put in $500. It would be unwise for the novice to agree to putting in the sale $500, given their lack of experience. They would likely end up losing money and getting crushed. Similarly, when it comes to the stock market, it's astonishing how many new investors lack a grasp of the fundamental principles of investing. Consequently, they often suffer significant losses within a few years. If you're new to investing, especially in the current volatile climate of 2023, it's crucial to familiarize yourself with these essential concepts. Let's start with the price to earnings, or PE ratio, one of the most vital metrics. It determines how much you're paying for a stock relative to its earnings. Another important metric is the return on equity, which measures a business's efficiency in generating profits. Also, have you explored the different types of stock market orders, such as limit orders, market orders, and stop limit orders? It's essential to understand these terms before diving into investing. Additionally, have you explored various fundamental strategies like Warren Buffett's value investing approach, which involves buying stocks below their intrinsic value? Another strategy to consider is the dividend aristocrat strategy, a group of stocks that can be dollar cost averaged into and potentially outperform the market in the long run, as historical data suggests. It's vital to comprehend these fundamental strategies and tactics, as well as grasp the concept of PE ratios before embarking on your investment journey. Number 4, daily news. While it may be one of the simplest investment rules, it's also one of the most challenging to adhere to. Many investors become fixated on the daily and weekly news updates regarding the stock market, resulting in a constant craving for information and a rush of dopamine with each news release. Consequently, around 90% of investors become engrossed in the short-term fluctuations of the market. Although this behavior may seem harmless, it can have a detrimental impact on your investment approach and ultimately affect your returns. One drawback of focusing on the immediate future is the failure to recognize the broader, long-term trends that unfold. When observing the stock market over a week or even a month, these periods represent mere specks within the larger, enduring pattern. If you remain fixated on short-term developments, your decision-making will be heavily influenced by them, leading to subpar investment returns. This is precisely why Warren Buffett advises investors to only purchase assets they would be content holding, even if the market were to shut down for a decade. Rather than being consumed by everyday news and trivial details, adopt a long-term perspective. Number 5, market cycles. Now let's delve into the concept of market cycles, which is particularly relevant in 2023 as we find ourselves in the latter stages of the cycle. It's crucial to familiarize yourself with how different stocks perform during various periods. Allow me to present an informative graph from the old school that will assist you in this endeavor. As you can observe, during the early to middle stages of the market cycle, certain sectors such as transportation, technology, and capital goods tend to thrive. This is because the economy is expanding and there is a growing demand for transportation services, while technology stocks often present lucrative opportunities during this time. Investing in these sectors like Netflix, Tesla, and Amazon 10 years ago would have been advantageous as the market was just beginning to heat up. However, as we progress into the latter stages of the cycle, more conservative stocks tend to perform better. Consumer non-cyclicals and healthcare sectors, for instance, become more favorable options. This is due to the fact that even during a market downturn, people still require essential goods like food, toothpaste, soap, and clean water. Therefore, owning stocks in the consumer non-cyclical sector provides a sense of security. Additionally, as individuals prioritize their health, healthcare stocks also demonstrate strong performance during this phase. As a beginner entering the stock market, it's crucial to grasp these concepts. Understanding which stocks perform well and when is essential. Remember, even if you invest in the strongest stock in the world, if it belongs to a weak sector, you may face losses. This is why I appreciate following Ray Dalio, who provides historical evidence and relates it to present circumstances. His insights help us to gauge our position in the market cycle and enable us to adjust our portfolio accordingly for the current market conditions in 2023. For novice investors, it may be tempting to wish you had started investing 10 years ago during the early stages of the economy and market. However, focusing on the present market conditions is vital. The tips I've shared with you will assist you in navigating the unique market conditions of 2023 and beyond. If you enjoyed this video, do hit the like button and consider subscribing to our channel for more investment-related videos in the days to come. Thank you for watching.